Hello, everybody. Welcome to another mediocre webinar. Alan Gassman is here. I'm Gandalf Denicolo, and we're going to talk about estate planning and asset protection. So, Alan, are you ready? I think I'm ready. All right. Well, I hope this is better than the last one. And the rehearsal was terrible. There was going to be a poem, but it's so bad I'm not even going to read it. Thank you, everybody. And if you need any magical services, such as pixie dust that we can put on your documents, then let me know. You can give me a call. I'm 1-800-BIG Mouth Puppet. All right, that's enough. Okay, bye. All right, welcome to this new installment of the amazing show from Hollywood, California. We walk, we talk, we bend over backwards and touch our toes, and we talk about asset protection from A to Z. Now, it is the Sabbath this morning. Maybe we should go from Z to A, but in any event, we are going to cover asset protection. If you logged in through cpaacademy.org, you'll get credit if you answer, I think, 3 of the 4 polling questions. So when we get to those, I'll go meow. When you hear meow, then you'll know to pay attention just for 1 minute, get the polling question, and then go back. Otherwise, I'll just droll on and you won't have to worry about me at all. If you came in through our website, then you will not get academic credit, and there is no reason for you to be here whatsoever. But you're welcome anyway. So we talk more on page 4 about that. And number 5, on page 5, within 3 to 5 hours, all of the non-CPA Academy registrants will get a follow-up email with today's recording and PowerPoint materials. If you're a CPA Academy registrant, send us an email and we'll give you the equivalent. Okay, and by the way, I said here, warning, they're not very good. I'm talking about the materials, not the CPA Academy registrants. They are pretty good. Most of them, maybe not you. All right, how do you ask a question? Well, if you scream at the top of your lungs, I'll probably hear you, but otherwise just click on the inverted pyramid there and then type in your question, and then I'll pretend to answer it if I can pretend to know the answer. Some recent and ongoing webinars, I wanted to mention that what we had on January 7th, Sri Kumar Rao, professional acceleration strategies, you can find it on our YouTube channel. If you just Google Gassman YouTube channel, Sri Kumar Rao, he had a very, very powerful and innovative presentation on the 7th. We had a lot of really good input on it. In addition, today is part 2 of asset protection from A to Z. Part 1 is also on the YouTube channel. It was presented December 10, 2022. And on December 3rd, we talked about trust law development and business entity planning. So please feel free to go and see those things. We have a book called What CPAs and Other Advisors Need to Know About Bankruptcy, and it is on Amazon. I'm enclosing my review here for the version of our book that we had for estate planners. If you're interested in it, go to Amazon. If you buy it on Amazon today, then I will mail you a copy of any other book that we have on Amazon. So today only, today is the 14th. If you buy this book on Amazon, then anything else you see on Amazon that you want under my library there, just send me an email, tell me you bought this, and I'll mail you the other one. And another book we have on Amazon is Gassman and Markham on Florida and Federal Asset Protection Law. If you want this, then let me know if you bought it, and I will send you the updated version as a Word document so that you can see what we've changed. Okay, I have some slides here beginning at page 20 for the tax professionals and for those of you who are interested in charitable giving. The Secure Act Part 2 that just came into effect had some very nice little changes to the charitable tax law. And I'm going to talk to you about a couple of them, but these are slides that were given to me by Carl Mill. Carl is one of the leading charitable tax lawyers in the country. He's very knowledgeable. So I'm always reading everything that he puts out. And he co-authors a book with us on charitable giving called, believe it or not, The Advisor's Guide to Charitable Giving, Reorganizations, and Creative Structuring. This is still in the development mode. If you'd like to be a beta tester, if you could agree to spend at least 1 hour reading it and giving us comments, which should include the comment, "Wow, what a great book," then I'll be glad to send this to you. We have transferred this book into, and see the beta fish, isn't he cute? Yeah. Hello, I'm a beta fish. All right, so we've transferred this book into a 501c3 organization so that law students can get pro bono hours donating their time to writing the book. All right, so what I wanted to mention about Secure Act 2.0 is the one-time ability of anyone who is having to take minimum distributions from their pension plan, which means they're over 70 and a half and maybe over 72, to transfer $50,000 from your IRA plan to either a charitable remainder unitrust, which can provide basically 90% of the economic benefit to you over a long period of time to delay your paying income tax on those distribution amounts, with the remainder going to charity. Or you can have up to $50,000 of your IRA go to a charity in exchange for its promise to pay you a charitable gift annuity over a period of years. So $50,000 doesn't sound like a lot of money to a lot of people, and it's better just to give the full 100 a year to charity. But if you have a client who is a little bit concerned, they don't want to give the whole 100 a year to charity, well, now they could give 50 to the charity and then get distributions from the charity under an annuity where the charity probably keeps $20,000 to $25,000 worth of the money for charitable purposes and then takes another 25 to 30,000 of that 50 and could buy a life annuity so the client receives money for the rest of their life. It doesn't run out no matter how long they live, and they don't have to pay the income tax except on the payments as they receive them. So I thought that was one really neat part of the new Secure Act. Another neat part about the Secure Act is, and I will see if I have a slide for it. If not, I'll just tell you about it. The ability for a 15-year-old 529 plan to be transferred to a Roth IRA for its beneficiary. So if 25 years ago you set up a 529 plan, your children haven't used the 529 plan, it's been more than 15 years since it was set up, then a certain amount from that 529 plan can be rolled directly into a Roth IRA. So that's a pretty neat provision in this new tax law. A third very nice provision, which really helps those of us who do the tax planning, is if you have someone who dies and their IRA is payable to a trust for a beneficiary who is disabled or chronically ill, that money from the IRA can be paid out to that trust over the lifetime of that chronically ill or disabled beneficiary, even if the second beneficiary on the death of that person is a charity. Because a lot of people do want to make their IRA payable to somebody and then the remainder going to a charity who's helping to take care of that somebody. So those are three of the changes from the new Secure Act. There's many, many more, including most notably the indexing for inflation finally for a lot of these things that have dollar amounts by them. But of course it's chained inflation, which is usually about only 2/3 of real inflation. So getting on to the subject at hand, creditor protection. In part one, we covered up through page 94. One thing that we discussed is it does not take all that much in damages to go above 1 million, 2 million, or $5 million. Somebody who gets hurt in an innocent car wreck and can't use their arm anymore could easily get a jury verdict of well above $5 million. So just to say, don't worry, I have a $5 million umbrella. That wouldn't even work for Mary Poppins. So that was one point we made. Here is a $730 million jury verdict. Now, we have clients that are pretty wealthy who say, well, I don't need insurance. Why should I get $5 million worth of insurance? I have a $75 million net worth, and I'm not all that concerned. Well, don't drive in Texas, because in Texas, this is where they bring all those class action and big suits, because the Texas juries just go bananas when they see something they don't like. Not to say that they're fruity. So then we talked about a typical asset protection arrangement. And just to refresh your memories, or if you're new to this presentation, here we have a single individual, and this person is looking to get married someday. So if you're interested, just send us an email and we can try to make an introduction. And the person has an IRA, a 401k, they have annuity contracts, they have life insurance, and they can fund a wage account. Well, in Florida and in many states, the IRA account is absolutely safe. The 401k account is safe. So put as much into the IRA and the 401k as you can. Then the annuity contracts in most states are also safe. Many states, like Florida, Texas, New York, have unlimited annuity contract creditor protection features. Life insurance cash value, which can include what we call private placement life insurance. I could put a business under a private placement life insurance policy. I could put real estate under a private placement life insurance policy. And then when I die, there's no capital gains tax because it's in a life insurance policy. So that's a good reason, besides the tax advantages, to put interesting assets into private placement life insurance. And then I have my homestead, or his homestead. He's single, I'm married, thank heaven. So the homestead in Florida, Texas, Michigan, and some other states is very, very well protected. In Texas and Florida, without any limit. In other words, in Florida, I could put $1 billion into a home on 160 acres, and the creditors wouldn't be able to touch it, even if I do it at the last minute, because the Florida fraudulent transfer statute doesn't apply to homestead. That's why the 2005 Bankruptcy Act says that if you go into bankruptcy within 10 years of committing a fraudulent transfer into homestead, then that can be set aside. So we have a lot of people in Florida who have judgments against them and they live in a homestead, but they make sure that they only have 2 creditors, because if you have 3 creditors, they could force you into bankruptcy. Okay, then there's the professional practice. That's harder to protect, but it could be subject to a lot of debt. And then you've got the professional building. Maybe it has a healthy mortgage on it. The mortgage may cross-collateralize the assets of the professional corporation. So my banker said, oh, I know why you want a mortgage on your building. It's because you want to cross-collateralize with the assets of your legal practice. So if somebody ever sued your legal practice, we could call the building loan in default, because the legal practice is a guarantor on the building loan. And then we could collect your accounts receivable, furniture, and equipment, and there would be nothing there for the plaintiff lawyer. And I said, no, that's not why I need to borrow money on my building. I need to borrow money. But that is the way that it can happen. Now, we also, I believe, discussed charging order protection last week, that in many states, the only remedy of the judgment creditor of a member of an LLC is to get a charging order. Now, in most of these states, there needs to be another legitimate member of the LLC for charging order protection to work. So for many single people, we establish an irrevocable trust, creatively called a gifting trust. It's for children, grandchildren, nieces, nephews, your next door neighbors, somebody you really care about. It owns 3% of the LLC that owns the building. It owns 3% of the limited partnership that owns the client's securities. And now when somebody gets a judgment against the individual, they can't touch the exempt assets, and all they can get against the 97% of these LLCs is what's called a charging order, where the judge says, if and when you make a distribution from this entity in cash or in kind, it has to come out pro rata, and you must pay the creditor 97%. But the judge has no power to force a distribution. So the typical plaintiff lawyer who says, I see you have limits of liability of $1 million. I think if I take you to court, my client could get $3 million. Give me a financial affidavit. Okay, the financial affidavit says, here's all these assets that creditors can't touch, and here's a charging order asset. Well, the plaintiff lawyer says, the last thing I want is a charging order, because then my client's going to call me every week and say, where are you on the charging order? Where are you on the charging order? So I'm going to settle for the $1 million of liability insurance. Now, here is a good question that comes up, and that is, you're a lawyer and a client comes to you and says, I was in a bad car accident 2 weeks ago. Should I hide my assets? And the answer is no, you probably should not hide your assets. Number one, you can't legally commit fraud, and you can get hurt severely by telling somebody an untruth or by concealing assets and actually lying about who owns them. On the other hand, if you form an LLC and you put $970,000 of assets into the LLC, and an irrevocable trust for your children puts $30,000 worth of assets in the LLC, and you put in your financial affidavit that you own 97% of an LLC, there is nothing dishonest there. And the plaintiff lawyer may say, wait a minute, you did this at the last minute. And then you may say, yeah, I did it at the last minute. It has a legitimate purpose. I'm getting my nieces and nephews involved in this LLC. If it doesn't work in this situation, it will probably work in the next situation. And at that point, the plaintiff lawyer may settle the case. So there's a lot of other alternatives and conversations you can have, but and a lot of it depends on what state you're in. If you're in the state of California or Connecticut, that could be an illegal act. Sometimes people move from California or Connecticut to Florida and then do their estate planning when they have something going on. Please don't try any of this at home. Please don't think you can wait till the last minute. But sometimes for some things, it's better late than never. Discuss it carefully with a lawyer who does a lot of Chapter 11 bankruptcy work. Now, why would I say a lot of Chapter 11 bankruptcy work? These lawyers have to know a lot more about creditor law than a typical lawyer who only does Chapter 7 work. Chapter 7 of the Bankruptcy Code says when you file bankruptcy, you get to keep your exempt assets, you get to lose your non-exempt assets, and it can be fairly simple, especially for people who don't have a lot of assets. But a Chapter 11 bankruptcy can be much more complicated. So it's for those of you out there who are estate planning lawyers and tax lawyers and CPAs, you're advising clients on choices. And then when things don't go well, they go to a litigation lawyer. And if you told them that you think it should have been choice B, and the client goes with choice B, what do you want to bet that the litigation lawyer is going to say, well, I wish you had gone with choice A. If we lose this case, it's not my fault, it's the estate planner's fault. So that's why it is better to bring that lawyer into the decision earlier rather than later, before the decision is made. Consider how to do that under attorney-client privilege. But we want that bankruptcy lawyer to buy into our plan. And bankruptcy lawyers, I can tell you, are not going to like offshore asset protection trusts or even Nevada asset protection trusts, because although they work, these lawyers will be ridiculed in the bankruptcy court for trying to protect these types of arrangements. The bankruptcy court judges, like any judge, want to be powerful and want to have control. And when I place assets in an offshore trust, they have no control. Their only hope, the judge's hope, is to find a chink in the armor to show that it's really a US-based trust, to find that there's US-based assets, or to put the client in jail on contempt if they can show that the client did something dishonest or some sort of last-minute planning. So we don't take these structures lightly. We normally use these Nevada asset protection trusts when there are good tax reasons to do so or no other way to protect assets. And please notice that even with the offshore asset protection trust that I'm showing you here, we have 1% owned by the gifting trust. And a reason for that is, even if a judge finds that the offshore asset protection trust is a bunch of bunk, then the creditor is only going to get a charging order against the FLP if the assets haven't moved to Liechtenstein by that time. So that's some creditor protection discussion. Let me go to a polling question now. Meow. By the way, that was not a real cat. Some people always say, is the cat real? And no, the cat's not real, but he lives in the Catskills. And he has cat skills, like he's good at hunting mice. All right, so page 104, first polling question. The answer is D, all of the above. What is the question? Like Jeopardy. A fraudulent transfer is not fraud. There's no dishonesty requirement. It's a transfer made for the purpose of avoiding creditors. So it is not fraud. And in many states, it is not illegal. B, a fraudulent transfer is a crime in some states. Yes, as far as I know, California and Connecticut. Okay, C, a fraudulent transfer may be set aside, which means that if I transfer my puppet to my assistant treasurer, who's here today working on Saturday, thank you for letting us do this, and I say, treasurer, I owe money to a bank, take this puppet and let it be yours. Well, the bank can come after treasurer. What can they get? They can get the puppet, or what the puppet was worth at the time of the transfer, and attorney's fees and costs. They can't take her to jail. They can't do bad things to her. So that is what the fraudulent transfer statute is. And treasurer would say, Alan, you should have given me a house instead. So treasurer, you can ring the bell when we have enough people who have answered, and I see that they've answered. All right. Now we're going back to page 95. Page 95, a typical family. When they don't like each other, that's why they're typical. Do you know how many people come to me and say, oh, I don't get along with my son, I don't get along with my daughter, I'm so unusual? No, you are the rule, not the exception. People just don't share that. But anyway, here's the real estate in one entity. Don't put the real estate in the business entity. There's the medical practice in another entity. There's the intellectual property in another entity. So a lot of times a client will come to me and say, hey, I have a wonderful business. It's called John's Pair of Pants. And people come from all over the country to go to the John's Pair of Pants stores. But I'm deathly afraid that somebody's going to trip because we don't always hem the pants properly. And then somebody's going to trip on the bell bottom and get hurt, and I'm going to lose everything. Well, we could make kind of like a franchise. We could make a John's Pants franchisor company and put the intellectual property, which would be the name and all the trade secrets and maybe even the operating software and the phone number, into the 1-800 number, into an LLC owned by one party, and then it could license the use of those assets to 3 other companies, one for each location, and they could pay royalties to the pants company. And then they could sign long-term leases with the real estate company, and the real estate lease could say, this is a 20-year lease. If you default, you owe 20 years of rent. So now if somebody slips and falls in the pants company, it becomes insolvent. The landlord terminates the lease, collects 20 years of rent. The bank collects whatever it can collect. And then the company, during that process, can go into bankruptcy, and it could sell its assets at arm's length in a bankruptcy approved sale, which takes a few months, but enables the buyer, who could be the best friend or spouse of the owner of John's Pants, to buy and then continue to operate the business with just a little bit going to the creditors. That was probably not a very good explanation, but it gets us to page 96. Page 96. First of all, I want to say that I had Professor Lind at the University of Florida LLM and Taxation program in 1982, and I'll bet some of you did too, and he was absolutely brilliant, covering Internal Revenue Code section 360A, which allows for tax-free reorganizations. And he covered A1A, A1B, A1C, A1E, A1D, which allows 2 separate businesses within a company to split up, A1E, and I don't think we got to A1F, or at least by then I was so tired I didn't understand it. So I always thought in my first few years of practicing law that when you come across a company and it owns the practice of the business, and it owns equipment, and it owns real estate, and it owns accounts receivable, and you go to the client and say, you silly goose, the goose that's laying the golden eggs is in the same barn as the risky stuff, as the good stuff, and when the fox gets in the barn, they're going to eat everything. Why don't you divide this into one company that owns the real estate and leases it, one company that owns the MRI machine, and one company that owns the medical practice? Well, most CPAs said, you can't do that. You'll trigger income tax under Internal Revenue Code section 311. 311 takes away the heaven, because when you transfer an appreciated asset from an S corporation or a C corporation to its shareholders or another company owned by its shareholders, you trigger gain as if the property was sold at fair market value at the time of the transaction. And therefore, all of the CPAs attending this presentation will receive credit because I talked about tax law. Well, under 368A1F, which we call a new parent F reorganization, to be frank, for F, first, you set up your new parent company. You shine it up, you get it a tax ID number, it makes an S election, or it could be a C Corp. Then if you have an S Corp, such as the medical practice entity, you transfer ownership of the old S Corp to the new parent S company, and the old company, we'll call that old co. That's like law lingo. You call this one new co, NEWCO. And you call this one Oldco, OLDCO. Maybe I'll write a poem about that someday. But now this is a tax-free transfer, and you make what's called a Q sub election, a qualified subchapter S election. It has nothing to do with a sandwich, but the assets will be sandwiched. So you could call this the Q sub sandwich maneuver. Those of you who are in California may be an omelet sandwich because you're eating breakfast still. In Florida, we're drinking Bloody Marys. All right, so anyway, the practice company has the business operations, accounts receivable, furniture, and equipment, and it transfers to the sibling entity the equipment and the real estate. So this is tax-free because it's all considered to be under the same new S corporation. And now the equipment is out of the medical practice and the real estate is out of the medical practice. So somebody who then has an event, say the doctor makes a mistake the month after you do this, their cause of action is against the medical practice company, not against the company that owns the equipment or the real estate. That's good stuff. Now, for you CPAs, the medical practice company keeps its tax ID number. The IRS was very generous in the regulations to allow that. Because if you're a medical practice, for example, you would have, to change your tax ID number, it is just easier to get the Red Sea apart and walk across it. Because if you change a tax ID number on a medical practice, you have to go to all the managed care plans and Medicare and Medicaid and everywhere else on earth and explain. But here you only have a simple change of ownership. Medicare does not inspect or look at the situation. Now, the new parent, though, files the next year's S Corporation Form 1120 and simply reports that it is the successor. The medical practice entity, the Q-sub, doesn't have to file any tax returns. And I'm now calling these sibling companies. They used to be called brother-sister companies, but now they could both be sisters or both be brothers. In this day and age, I think they're just called sibling companies. If anyone has a better name for that, please let me know. Okay, now, another thing you can do here, if you're not already tired of this chart, how are you going to protect the accounts receivable of the medical practice? Well, usually it's not that big of a thing to protect the accounts receivable because in a lot of medical practices, they get paid very quickly on their accounts receivable. Medicare pays within 12 days electronically usually. And if you get sued for malpractice, you've got a couple of years before it comes to trial. So you're not going to have a lot of accounts receivable at the time of trial. But what you could do if you want to do some income tax planning is form a separate family limited partnership owned by the children and have it loan money at a high rate, say 14%, to an accounts receivable factoring company, which is another one of the sibling companies. The accounts receivable factoring company buys the accounts receivable from the medical practice and gives it money. So then the accounts receivable company makes profit, but it pays 14% interest to the family limited partnership. So that moves interest income to the children, whether they deserve it or not. It could be Section 678 trust for the children where they don't even get it, they're just taxed on it. And that is my story. And we call this over on the right the elope arrangement. I don't even remember what it stands for, but it was cute. If you Google Gassman elope, it has nothing to do with romance. It is only a way to protect your accounts receivable. So let me go to the second polling question. Meow. Okay, 156. By the way, that was not a real dog or a real cat. Those are simply figments of our imagination. Now we're going to talk about variable annuity contracts. Number one, they may not be expensive. There are some very expensive annuity contracts and very inexpensive. Let me tell you what an annuity contract is. It is a contract, well, you already knew that, between an individual or entity and an insurance company. And the individual or entity gives money to the insurance company, and the insurance company agrees to pay a fixed rate of interest or a rate of interest based upon the performance of mutual funds. So Fidelity, for example, has a very competitive variable annuity contract arrangement. I give Fidelity $300,000. I sign the annuity agreement, and I tell them which Fidelity mutual funds I want the annuity contract to be invested in. Fidelity charges me, I believe, 0.25% a year above the normal mutual fund charges. And now, under Florida law, a creditor cannot touch that variable annuity. So A, it can be inexpensive. On the other hand, there's annuities that cost 8 to 10% in surrender charges and 3% a year to maintain, not as popular. B, an annuity contract can defer income tax. So I give Fidelity, and by the way, I have no financial relationship with Fidelity, although I have Fidelity. Anyway, I give them $1 million. The annuity is suddenly worth $1,100,000 because the market went well, or $1,100,000 because of the interest income in the annuity. When do I pay the tax? I don't pay the tax until I pull the money out. So I have tax deferral. On the other hand, when I pull the money out of the annuity, I have to pay a 10% excise tax if I have not reached age 59 and a half. That's a 10% excise tax only on the income that I pull out. And the income comes out at ordinary rates, which would hopefully be 37%. So if I would have put that into a mutual fund that would have grown by 10%, and I could have waited to sell the growth in the mutual fund, and I would have paid capital gains tax. Instead, I've converted that to ordinary income, which can be a bad thing. And that's the problem with variable annuity contracts. And there are US-based variable annuity contracts and international-based variable annuity contracts. So if a judge in your state says, I don't like that annuity contract, well, sorry, you don't have jurisdiction over it. And the answer to the questions is all of the above. Okay, let me go back to where I was, get back to where you once belonged. If you haven't seen the Disney Channel Beatles thing on their live rooftop concert, then I recommend that you watch that instead of the rest of this. And here is page 98. Now, I was at the Heckerling University of Miami estate planning conference this week. And in a couple of weeks, I'm going to tell you what I learned, because I'm not sure yet what it was. But one thing I learned is that as soon as 2024, if they don't extend this, just about everyone, other than big publicly traded companies and regulated companies, will be filing a new report with the government. I know you were pleased to hear that. And you'll be telling them on that report, here's the names of all my companies, here's the owners of all my companies, here's who set them up for me, and here's who has management authority. So we haven't seen the form yet. The form hasn't come out. I hope it's a one-page form. More likely it's a 4-page form. And most people in the audience groaned, but a lot of people said, oh, good, I can charge to fill out another form. But that loss of privacy to the government will not apply to an entity that does not register with a governmental agency. So when I set up an LLC, we form ours mostly in Wyoming, Colorado, and Florida, because Wyoming and Colorado have really good secrecy rules and are very inexpensive for filing fees. Florida is inexpensive but does not have as much confidentiality. But I can also form an irrevocable trust. So let's say I have a rental house and I want to rent it to Debbie Reynolds, and Debbie may sue me if she gets hurt. So I could put the rental house in an LLC, but then I'll have to register this in 2024 unless they push that law back. Or what if I name my daughter the trustee of an irrevocable trust for my daughter and my wife, and provide that after 15 years, I can be added to the trust as a beneficiary. And then that trust owns the rental home, and my daughter administers that rental home the same way that she would if she was the manager of an LLC. Well, now I don't have to file an LLC. I don't have an annual report for an LLC. It won't have to be reported under the new disclosure rules. It's not a taxable entity if I retain the right to replace trust assets with assets of equal value. And my insurance carrier may like it a lot better than an LLC. In Florida, the insurance carriers just don't like LLCs for residential real estate as much as they like trusts. So this, if you are in a state that has adopted the Uniform Trust Code, then this is certainly something to consider. Another thing to consider for you people who are in California, if you're awake yet, because I know you party late on Fridays, is if you have real estate outside of California, you are aware that California imposes an $800 a year charge on the privilege of a California person owning an LLC anywhere else. Well, you could use a New Hampshire or Wyoming foundation. Those are similar to LLCs, but not exactly LLCs. And I don't think that they're companies that would fall under that California $800 a year rule. Or you could look into whether California law and the law of the state where the activity or real estate is will protect you under what I would call an asset protection trust. Okay, I'm going to look for questions now and see if there are any questions. The first question is, can the puppet come back and can you leave? Secondly, who's the dummy today? Well, I'm the dummy today. The puppet does not like being called a dummy. He calls me a dummy. Okay. Is the qualified charitable distribution to the CRUT $50,000 for 2023? Yes, it is. It is in place now. So, you know, one question I'm asking, and I'm interested in your thoughts on this, is what charities will pay for the charitable remainder trust to be set up so that they can receive the equivalent of about $5,000 in value if you set up a charitable remainder trust for your distribution, which you can do this year. And I am thinking, if anyone's interested, I operate the Sarah Gassman Foundation, which gives piano lessons to children in need. We've been around for, I think, about 15 years now. We've taught over 1,000 piano lessons. So I will, for the first 3 people who ask me and put $50,000 into a charitable remainder trust, if you are a CPA, and if you will serve as trustee of that trust, I will set charitable remainder trust up for you for free. And when you die, every dollar of what's left in that trust will go to the Sarah Gassman Foundation and will be used to pay for piano lessons for piano teachers to give one-on-one piano lessons to needy students. Now, the question is your charity going to do that? I do not have an annuity set up. I think my clients would rather have their own $50,000. Now, why would a charity do that just for $50,000? At Heckerling, the people on the podium said, well, you know, it costs thousands and thousands of dollars to prepare a charitable remainder trust. I don't think it should cost thousands and thousands of dollars to prepare a charitable remainder trust. I know one of my colleagues did one recently for $750. And in all due respect to everyone out there, if you do a simple charitable remainder trust, it should not cost that much. Now, the second objection is, wow, they're so hard to operate. You have to file an annual return for them. Well, I don't think the annual return is all that difficult to file. Oh my gosh, the client will do it all wrong. They'll forget to take their annual payment. They won't know how to measure the percentage of the value of the CRUT. Well, that's why I'm making this offer to CPAs and lawyers. But the real advantage for most charities, in my opinion, will be just the ability to interact once again with a dedicated donor. And you could say, hey, as long as you're doing this $50,000 charitable remainder trust to stretch your IRA payment and delay income taxes of $18,500, would you mind if we did an identical one and you give some appreciated assets from your marketable securities portfolio, and then we'll have $250,000 set aside. So, you know, just some thoughts there. Now, under Florida law, according to the bankruptcy court case of In re Mart, M-A-R-T, I think, or M-A-R-T-E, a trust which pays me an annuity interest is not subject to my creditor claims. So if you have a creditor situation and you want to do this in a state that protects assets from creditor claims, you could put $50,000 in the charitable remainder trust and use $45,000 essentially to fund an annuity contract that will pay back to the client, and the remaining $5,000 in theory and generally will end up going to the charitable organization. And yes, the charitable organization could be your own family foundation. Okay, are there any strategies for avoiding the beneficiary having to pay income tax when the owner of the variable annuity with large gains dies? Well, you have 5 years to pull it out of the annuity, but I am not aware of any effective way to completely avoid the ordinary income unless you can generate deductions. I guess if you pull $1 million of income out of the annuity and you buy a charter boat that year and you use it only for third parties to use the charter boat, then you could get $1 million tax deduction. And then the next year, if you do it right, you could also use the charter boat as long as you pay rent, et cetera, et cetera. Okay. Is there an expiration date on the $50,000 one-time Secure Act transfer? No. To my knowledge, there is no expiration date, Rob. It can be completed in 2023. And Rob, I want to thank you for watching so many of our webinars. And I would also like to thank whoever your mental health counselor is, because you just keep coming back no matter how mediocre they are. By the way, I wanted to mention that at the Heckerling Institute, one thing I learned is that we do have a lot of viewers of this webinar, and a lot of people watch this webinar with their spouse or their significant other. And that's just one thing that tax professionals are doing with their spouses. Now, I don't know if you've got your computer in the hot tub or how all that works, but I'm just pleased, and I appreciate any and all suggestions. Okay, Nancy, does the IRA distribution to the trust for the beneficiary of the special needs beneficiary then remain to charity allow the IRA to be considered separate accounts? Yes. I listened to Natalie Choate on this just yesterday, and her outline says yes. Even not only that, but if you say, I want my IRA to go to 4 separate accounts for my 4 separate children, if one of them is chronically ill or disabled, then those are considered 4 separate accounts. Otherwise, not so good. All right, well, everyone's asked me tax questions and no one's asking me asset protection questions. So what should we do? I think we should do the last polling questions in case there are CPAs out there who want to stop watching. If you could imagine that, CPAs who would want to stop watching. By the way, when I get there, 205. All right, I have a magic trick. Watch. See? All right, so here's the polling question. Under the reciprocal trust doctrine, A, each spouse forms a trust for each other, and therefore it's like they each formed a trust for themselves and they become subject to estate tax. And also creditors can reach in. In other words, if I form a trust for my wife, Marcia, and in the same year or the next year or even another year later, she forms a trust for me, well, creditors are likely to say, hey, you really just formed a trust for you, and she really just formed a trust for her, and we can reach in. So the IRS has the same type of arrangement under what's called Internal Revenue Code Section 2036A, and they call it the reciprocal trust doctrine. Now, there's a U.S. Supreme Court case, U.S. v. Grace, which said, well, you know, if the trusts weren't formed at the same time and they have different kinds of terms, we're not going to uncross them. Well, and then there was another case that was a tax court memorandum decision, which has no precedential value. I personally do not trust the reciprocal trust arrangement. I will have the husband set up a trust for the spouse and descendants. I'll have his spouse set up a trust for descendants only. And then they're very different. And then I'll provide that the trust for the spouse, in the event of a divorce, will divide into two trusts. One continues to be for that spouse beneficiary. The other is controlled by the grantor spouse, but not for the grantor spouse. The alternative is you draft these trusts carefully in an asset protection jurisdiction such as Nevada, Alaska, Delaware, or South Dakota. And the answer is all of the above, and you should be thoroughly confused by now if you're listening in any way. One of my favorite sayings by Tom Peters, who wrote the book In Search of Excellence and Thriving on Chaos, two wonderful, wonderful books, is if you're not confused, you are not paying attention. All right, so let's go back to where we were, back to where you once belonged. I wish I could play the guitar. All right, equity stripping. I have mentioned the hot tub. This is not quite the same thing as the hot tub. With equity stripping, you want to reduce the value of an asset by having debt against the asset. So here is an example of equity stripping, and you don't have to do this with a hot tub. Tom has a manufacturing company worth $10 million, and it manufactures hot tubs. And because people are so careless because they're watching videos in the hot tubs, they tend to get hurt. So he is afraid he'll lose the whole business in a lawsuit. He doesn't owe money, and he doesn't want to owe money. So could the manufacturing company simply give him a $9 million promissory note? And the answer is yes. This is America. Tom owns the company. He is allowed to tell the company, hey, if you want to continue to operate, you need to owe me $9 million. A signed promissory note, preferably secured by the assets of the widget manufacturing company. Now somebody comes and gets hurt, they sue the company. They get a judgment against the company for $20 million. Tom goes into puts the company into a Chapter 11 bankruptcy and offers to buy the business of the company for $10 million. He'll get the first $9 million, the creditor will get $1 million. If the creditor wants more money, they need to go find somebody who would pay more than $10 million for the business. They're not going to be able to do that. They're not going to want to do that. They're going to settle this case for $1 million before trial if this is what they are facing. So simply being owed a note from your own company can be very effective. But here's the problem. Well, Tom has many problems because most of my clients don't have just one problem. They only have the problem they came in for, not the problems that you tell them they also have. Tom's income tax basis in the manufacturing company is only $500,000. So if the company gives him a $9 million note, he's going to have $8,500,000 in debt. And that's why you shouldn't try to do this stuff on your own. You should always ask your lawyer and ask your accountant and ask your psychic and ask your hairdresser before you do all this stuff. So what can Tom do? Well, Tom could set up, believe it or not, a new parent F company. So Tom sets up a new S corporation because his widget company is an S corporation, and he owns 100% of the new S corporation, and he transfers the ownership of his widget company to the new company, and he takes a $500,000 note, which he's allowed to do without triggering tax, And then an $8,500,000 note is given by the new subsidiary, which is Old Co. Remember, we know Old Co, New Co, all around the town. And then he has some creditor protection without causing any sort of tax issue. Now we will. Okay, last polling question is on page 128. I'll get to it in just a minute. Thank you, Treasurer, for interrupting me. Okay. What was I going to say? Okay, we will often set up this new parent company and then put the intellectual property in the parent company and then have the parent company partly owned by someone else so you can get charging order protection. And then, by the way, move the assets that are valuable, some of the assets that are valuable out of the widget company into the brother sister company. All right. Riley just reminded me that I did not do all 4 polling questions. And by the way, things really go fast when you're in the hot tub, don't they? So I now have polling question at page 128. And 128, which book would you like to receive a free PDF of? Number 1, our book, 8 Steps to a Proper Florida Trust and Estate Plan. Number 2, A Practical Guide to Kickback and Self-Referral Laws for Florida Physicians. Number 3, Creditor Protection for Florida Physicians. And number 4, Florida Law for Tax, Business, and Financial Planning Advisors. And if you are not in CPA.org, so you're not answering the poll, if you're not answering the polling question, just send us an email. Tell us which book you want, and if we don't forget, we'll send it to you. All right, I think that ends the slides I was going to cover. Now I'm just going to answer a few more questions, and then we will end. Let me see, is the poll over, Treasurer? All right, good. All right, now a few more questions. Is this almost over? Yeah, it's almost over. Thank heaven, it's getting really old. I agree. I'm having double of a time understanding you. I get it. I can move my hand though. Oh, good. All right. Other than creative paranoia, what are the real risks of the disclosure of the Transparency Act? John, thank you. The only risk I'm aware of is having to pay your lawyer or your CPA or spending the time to file the disclosure. I don't think there's any risks of the Transparency Act, and the IRS already knows about these entities. I have nothing to hide from the US government. I agree with you completely. Are there other states besides New Hampshire that have foundations to register rental real estate to avoid the 800 California? Yes, it's New Hampshire and Wyoming. And then, for example, if the real estate is in Florida, the Wyoming Foundation could own a Florida land trust, which could own the property. So that would be worthwhile for my friends in California. Then you could afford another banjo for your knee each year. Okay, okay. Hello from Blizzard Central, Buffalo, New York. Thank you, Bruce. That's a great question. All right, the 529 plan rolled into the Roth IRA. How long does the money have to be in the 529 plan before you can roll it over? 15 years. Is this rollover taxable? No, but it's limited to a small amount, like I think $25,000. Does it have to be completed in 2023? No, this will be around for a while. And it's nice. It shows you that it's okay to overfund a 529 plan, which I always thought it was fine to overfund a 529 plan. As I said in part 1, clients tend to underfund 529 plans, or they put the money in slowly. Put a lot in that 529 plan and don't wait. Just put it all in there. How does private placement life insurance work, David? It works very well. The life insurance tax code, I will call it, is very advantageous for policyholders. I can give money to an insurance carrier, and the insurance carrier can put that money in investments that I choose, and then in addition, put together what's essentially a term life insurance arrangement. So I give the insurance carrier money, the policy has what they call a cash value, and then the insurance carrier uses some of the money from the cash value to pay the premiums on a death benefit arrangement. And then what are the advantages? Number one, creditor proof. Number two, if I die, what comes out of that policy comes out totally tax-free. The only issue is I have to die first, which won't bother a lot of my descendants. Then the third advantage is no income tax on the income within the policy. The fourth advantage is I can withdraw income tax-free an amount equal to what I put in. So if I put $1 million into the policy over 5 years and it's worth $2 million, I can withdraw $1 million tax-free. Next advantage is that I can borrow the rest out tax-free as long as it's a legitimate loan. And when I die, all that loan gets forgiven and there's no income tax. The next advantage is I can do this in an offshore, I can do this in a US jurisdiction. South Dakota is very popular because they have a lower premium tax, or I could do it offshore. And if I do it offshore, good luck to any creditor who wants to try to get hold of it. What can be put into a private placement life insurance policy? Just about anything. I've dealt with situations where people have put millions of dollars worth of diamonds and colored stones into a life insurance policy. I've had situations where people have put business and real estate into a life insurance policy, or unique investments into a life insurance policy. So now, what are the disadvantages? There's 3 of them. The cost, and the cost. You have to see how much it costs. And by cost, I mean, number one, the cost of figuring out who's a good carrier and how the arrangement works. Number 2, the cost of actually paying the carrier who you choose. And number 3, the cost of lack of control. I could tell Fidelity what to buy inside a US-based conventional life policy. But if I want to set up a private placement policy, the investment advisor could be my friend, could be somebody who I respect, but they make the decisions, not me. I can make suggestions, but I cannot control it completely. And there's a famous court case called the Weber case, W-E-B-E-R, where the IRS really grilled Mr. Weber. You get that? I just made it up, like a barbecue grill. But Mr. Weber specifically told the investment advisor what to buy, sent him, I think, over 1,000 emails telling him what to buy. And what's really nice about the Weber case is that the court did not disqualify the life insurance policy and allowed some of the benefits of the life insurance policy to still apply, even though Mr. Weber ended up having to pay income tax on the income of the life insurance policy. And I had the feeling when I read the case that Mr. Weber was looking for creditor protection because it was an offshore policy, and I think he got the creditor protection. Okay, Rob thanks me for the kind words, and also his counselor thanked me as well. Okay, Kathy, thank you very much for being a beta tester for your book, for the book. I appreciate that. Now, the beta we send you will be just like a 6-month-old beta. She's going to need a nice little glass to live in and food every day. And then I want you to read her the book and see how she does. And that's what I mean by a beta tester. Okay, Colorado residents set up a California LLC in 2021 to own and operate a California rental property and file Form 468 to be taxed as an S Corp as written in their articles of organization. Per California rules, the $800 fee was waived in 2021 but is due in 2022. Should Colorado partners form as a separate entity to, sorry, I can't read the rest of the question, Shannon. Sorry, everybody, I will read Shannon's question and answer it the first thing next week. Thank you, Rose, for also being a beta tester. I don't know what that was, Rose, I'm sorry, you misunderstood me. A beta tester, not a beta taster. I don't know what a beta fish tastes like. And to be honest, I don't want to know what a beta fish tastes like. All right. Thanks again. Thank you, Jim, for also agreeing to look at the book after tax season. And thank you, James, for saying this was a nice webinar. CPA Academy does read all of your comments, and all of your comments go on a nice spreadsheet, which the authors share with their mothers. Thanks again for all of your attentiveness during this webinar. Many of you actually stayed after the noon hour. I hope that you use some of the information, any of the information that we shared today for your clients, your family, and your friends. The American legal system was set up to enable people to protect their assets from spurious litigation. That's not a substitute for good insurance, and that's not a substitute for you acting reasonably, staying away from people who you shouldn't be hanging with, and not having enough insurance. And finally, only you should drive your car, and you should drive it only so far. Do not drink and drive or text. We'll see you at the webinar next. All right, Treasurer, cut it. Cut it.